Welcome back to the Investing Iguana. Today we're unpacking ST Engineering's first half 2025 results. If you care about steady dividends, strong visibility, and real operating leverage, this one is for you. In Singapore, great outcomes start with great data. That's why we go beyond headlines and read the slides. I'm Iggy. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed 1 million reads and 58,000 likes. I've produced over 1,000 videos with more than 600,000 watch hours as of August 2025. I track both regional and global macro trends. Today, we're doing a crucial deep dive into ST Engineering's 1H 2025 results. Stick around to see what it really means for your portfolio. We'll go slide by slide. We'll cover group performance, revenue mix, EBIT drivers, the 31.2 B-Day order book, contract quality, debt and cash flow, divestments, segments like Aerospace and Defence, and the dividend cadence. I'll keep it SG first with clear CPF and SRS takeaways. All right, let's look at slide 5. Group financial highlights. Revenue was 5,906 on, up 7% year on year. EB8 came in at 602 mils, up 15%. Net profit rose 20% to 403 mils. EPS is 12.93 cents versus 10.80 cents last year. What does that tell us? Profit is growing faster than revenue. That's operating leverage and better margin mix. Think of it like a hawker who upgraded to a central kitchen. Same ingredients, more output, better margins. Why should SG investors care? Because this profile supports both growth and dividends. In CPF/SRS portfolios, this mix often leads to smoother compounding. Do you want a stock that relies on luck or one that earns its way forward with improving quality of earnings? Next, slide 6. Revenue breakdown by segment type geography. By segment, defense and public security, DPS, is about 45%, commercial aerospace, CA, 40%, urban solutions, and SATCOM, USS, 16%. Geography, Asia, 54%, US 20%, Europe, 20%, others, 6%. This is a three-legged stool. If one leg wobbles, the other two keep you stable. DPS brings resilient, often government-backed demand. Aerospace MRO rides, fleet utilization and OEM ties. Urban Solutions taps rail and city systems. For Singaporean investors, this is why ST Engineering is a core defensive industrial. You're not betting on one cycle. You're buying a diversified engine that holds up when markets get choppy. How many SGX names can say the same? On to slide 8, 1H 2025 EBIT. The bridge shows EBIT rising from 523 mils to 602 mils, driven by business growth, better margin mix, and cost savings. This looks more structural than cyclical. Scale in engine MRO, growing defense digital systems and rail projects can sustain margins. Cost programs alone fade. Mix improvement can persist. Why it matters here at home. This supports payout stability and valuation resilience. For CPF and SRS, a company improving its unit economics while growing revenue deserves a premium over plain vanilla industrials. Slide 17, contract wins and order book. Order book stands at 31.2 as of 30th June 2025. Contract wins in 1H 2025 were 9.1 SPA. Management expects about 5.0 EBIT to be delivered in 2H 2025. That is powerful visibility. It's like having years of tuition fees prepaid. You can plan with confidence. For dividend-focused investors, the backlog underwrites cash flow behind the 4.0C interim cadence. For growth investors, it supports future revenue and EBIT expansion. Ask yourself, in a world of uncertainty, how valuable is 31.2 years of contracted work? Slide 18, 2Q25 new contracts by segment. Total new contracts were 4.7 B, split across CA, 1.5 B, DPS 1.5 B, and USS 110.7 B. In commercial aerospace, you see CM46 to 5B, 7B MRO offload with a major OEM, a 5-year LEAP-1A engine MRO with Air Cairo, and CFM56 to 7B heavy checks for North Asia. Add 737 NG component services in Southeast Asia and multi-aircraft A33 P2F orders. This isn't one-off sales. This is sticky MRO and components work. Airlines must maintain engines regardless of the cycle. In defense and public security, wins include high-performance GPU data center infrastructure, AI-enabled command and control, training and simulation, cybersecurity, ammunition, and multi-domain MRO. This is where defense and AI meet. It's a good place to be for margins and durability. In urban solutions and SATCOM, we've got turnkey rail services, Taichung MRT Blue Line, platform screen doors, Chennai, New Taipei, U.S. tolling and intelligent transport, smart security projects in Singapore, and SATCOM ground infrastructure for government and enterprise, including Saudi upgrades. These are long-cycle, system-level contracts with high switching costs. For SG investors, this mix matters. It tells you the backlog has quality, not just quantity. It supports the thesis that margins can hold even if the macro softens. Slide 20. Debt management. Borrowings decreased to 5.5B at 30 June 2025 from 6.5B at end 2022. Gross debt LTM EBITDA improved to 3.2x. Debt mix is 71% fixed and 29% floating. FY 2025 borrowing cost is guided to mid 3%. Credit ratings are KWA stable, Moody's, and AA+ stable, S&P. 1H 2025 EBITDA rose 11% to $871. Why this is important? We're still not back to a cheap money world. So fixed rate tilt plus top tier ratings mean fewer surprises in interest expense. For CPF portfolios, it reduces downside. For SRS, it adds optionality for disciplined M&A or buybacks if valuations allow. Slide 22. Portfolio rationalization, Liboy and SPTEL. Management expects about $450 net proceeds, with an estimated one-off divestment gain around $180 million and roughly $15 in annual interest savings, pending approvals in 4Q 2025. Implied multiples. Liboy at 9.3x EV/EBIT and SPTEL at 21.4x. Pro forma 2024 for the divested entities. Liboy revenue, $326 million. EBIT, $37 million. SPTEL share of net loss, about $2 million. This is capital recycling. Selling non-core at fair multiples. Deleveraging or reinvesting into core engines. That's how you sustain ROIs. It's what we want to see in SG Industrials. A clear playbook, not empire building. Now, the segments. Slides 12 and 31. Commercial aerospace. Revenue rose 5% to around $247 million. EBIT up 18% to $223. Mixed tailwinds from engine MRO and nacelles offset softer PTF conversions. Subsegment detail shows MRO strength, softer aerostructures and systems, and aviation asset management AUM up to USD 1,402 million from USD 1,148 million. Why it matters. Engine MRO has high barriers and recurring demand. Airlines cannot skip maintenance. OEM linkages and certifications protect pricing. This is a compounding engine that can fund dividends and growth. Slides 13 and 33. Defense and public security. And revenue up 12% to $2,648 million. EBIT up 13% to $367 million. Broad-based gains. Defense aerospace up 14%. Digital systems and cyber up 9%. Land systems up 12%. Marine up 7%. With regional defense modernization and cyber demand staying firm, this has a multi-year runway. Singapore's predictable defense spend supports the base, while regional orders add torque. Slides 14 and 35. Urban solutions and SATCOM. Revenue flat at around $920 million. EBIT up 32% to $12 million. Urban solutions slightly higher. SATCOM saw lower revenue, but is in transformation. The Intuition platform is on track for a general release at the end of September 2025, with standards, cloud, multi-orbit, and virtualization features. Customer transitions are taking longer, but traction is improving. Why it matters. Strong EBIT despite flattish revenue means mix and cost work are paying off. If Intuition wins with government and enterprise, margins can lift. Let's touch dividends and cash. Slide 24 in appendix. Dividends and cash flow. Interim dividends. 4.0 cents for 1Q2 25, paid 3 June 2025, and 4.0 cents for 2Q 2025, payment due 5 Sep 2025, totaling 8.0 cents for the half. 1H net profit was $403 million. Net cash from operating activities was $761 million. Short-term liquidity is backstopped by a committed revolving credit facility that exceeds the commercial paper outstanding. The group notes strong credit ratings and no financial covenants on key facilities. For CPF investors, this is classic income plus resilience. For SRS, it balances yield with growth exposure to MRO, defense digital, and smart city systems. If you want the detailed financial model, order book burn scenarios, and an extended valuation breakdown, we've prepared a premium post on the Investing Iguana Substack that complements this video with even more granular data. For even more granular data, detailed financial models, and a full written breakdown of this ST engineering report, including an extended valuation analysis, make sure to check out our Substack. The link is right there in the description. So where do I land after this slide by slide? Based on this report, ST Engineering is a buy for Singaporean investors right now. Why? Net profit up 20% on 7% revenue shows operating leverage. The 31.2B order book and a 5.0B targeted for YTK delivery support near-term revenue. Debt is trending down with a fixed rate tilt and high-grade ratings. Capital allocation is rational with divestments aligned to core focus. And the interim dividend cadence looks well underwritten by earnings and cash flows. Risk to track. Tariff or geopolitical disruptions. Management flagged limited direct impact with $34 million of deferred revenue in China. Engine MRO over about 2.5 months in 2Q 2025. Execution on large backlog and complex projects. Interest rate exposure on the 29% floating slice. And Satcom's transition pace as Intuition rolls out. How I position this in a Singaporean portfolio. In CPF, as a core income plus growth holding. In SRS, as a quality industrial with defensive characteristics and secular tailwinds. If you're worried about entry timing, dollar cost average over 3 to 6 months and monitor 3Q, 4Q order intake and the Intuition launch milestones. Quick recap. Profit is growing faster than revenue. Backlog is deep and diverse. Debt is managed with care. Capital allocation is disciplined. Dividends are steady. This is the profile we want in a core SGX holding. If you enjoy this level of detail, you're already ahead of most. Keep it up. Your portfolio will thank you. Please share your thoughts in the comments. What's your biggest question about ST Engineering's Satcom transition or aerospace MRO runway? Smash the like button if this helped. Subscribe for more deep dives like this. So, we've dissected ST Engineering's 1H 2025 results, and I've given you my personal take on what it means for your investments. If you found this video helpful and want to seriously level up your investing game, please give it a like, share it with your friends, and subscribe to the Investing Iguana channel so you don't miss our next insights. And for those who want to be truly ahead, our premium members gain exclusive early access to all our videos, often a full week before anyone else sees them. This means you get Iggy's detailed analyses and urgent insights on major market moves directly to your inbox, giving you a significant head start. It's just $3 a month, about the price of a cup of coffee. Think of it as your consistent daily dose of financial fuel for smarter decisions, delivered before the masses. Ready to join the inner circle and get that early edge? Just click the link in the description below to become a premium member today.